Okay. Okay, good afternoon, everybody. I know that it's a sunny day here in Portland, so I'm sure we won't have too many guys attending. But we'll muddle through, as they say. Let me go to the disclaimer slide here. Oops, if I can somehow. Yeah, this is our usual disclaimer that everybody probably is familiar with. Everything we say here should be taken with a grain of salt. Obviously, you should do your own due diligence and do your own. So we're here just to share information and move on from that, basically. This group is primarily aimed at income-oriented investing. So we look for, we're self-directed and we're looking for prudent opportunities and a stream of income, basically. That's really important here because this is a little different than buying, something where you're seeking capital gains. And we would like to protect ourselves from inflation and preserve our capital. So, on the whole, it's kind of a buy and hold approach. And so the audience we primarily aim at is the audience that are, either approaching retirement or in retirement. So, we're looking at a stream of income, basically. And then I always put this slide up. This is our Google group. I would highly recommend that you use it if you have an opportunity, if you want to post something or, something that you found interesting and you wanted to share it with everybody. By all means, use that Google group. It's a private group. It's not a public group. It's only available to people who have signed up through the AAI PDX income site. And Todd, are you online by any chance? Todd sounds like he might have been busy today.
No, I'm online, Andy. Can you hear me?
Yeah, do you want to talk a little bit about what's coming up and all?
Yes, we do have a meeting of the regular Portland AAII chapter on February 12th. And we're going to have a speaker for that event. And her name is Janet Brown, and she's experienced EXO investing, and she's has experience speaking in other chapters as well, got good reviews, so we're excited to have her. She's going to be speaking along the lines of how to invest in uncertain times, which should be timely given the situation we're dealing with this pandemic that doesn't seem to go away. So that's going to be that's a Saturday, February 12th from 9 to 11. And that will be a video call only, no in-person meetings. And so looking forward to hopefully seeing you all there. And there's going to be more information about that coming out in email, but please mark your calendars for, again, Saturday, February 12th from 9 to 11 a.m. Got an excellent speaker presenting, and we hope to see you all there.
Todd, is this the same Janet Brown that's with Schwab?
No.
Okay.
Nothing to do with Schwab, as far as I know, anyway.
Okay.
No. And she's written a book, books on ETFs and mutual funds. Okay. Well versed in protecting portfolios, which should be a good topic for all the people online today for the SIG group meeting too, because it's a more conservative type of investing. So.
Okay. Well, thanks. Appreciate that.
Thank you, Andy.
Thanks, Todd. Yeah, and then also I just wanted to mention, all the recordings for all the SIG and the main Portland chapter are online. This particular slide is a little outdated now. We've added a couple of more videos to it since I took this slide, but that's available at the Portland site. So by all means, if you're so inclined and you missed one of the sessions, by all means, you can go back there and watch the video, zip through the part where I talk and just listen to the speaker. And so it's a valuable resource, and highly recommend that you use it. Okay, I'm going to talk a little bit about, I'm going to do some warm-up slides on on utility stocks. And then I'm just going to open it up for discussion because I think it's important for us to share our knowledge, because I think there's a lot of guys online that really understand what's going on in these markets and really can share what they're doing. So just to get things started, let me share with you something that I found the other day that I thought was kind of interesting. And by the way, this is a side thing. These are some of the SIG tools that I use, for the kind of stuff, kind of analysis that I do. I'm basically a fundamental analysis type of individual. So I look at individual companies and I try to look at their financials and then try to understand exactly what the opportunities are. And these are kind of some of the tools that I've used in the past. I don't subscribe to all these. I don't subscribe to Simply Safe dividends, but a couple of our members do. And I don't subscribe to Portfolio Visualizer, although I use the free version of it. I do subscribe to the AI dividend newsletter, and the Morningstar and the Value Line. I can get those free online at our local library here. I've been using those as well. So I just wanted to mention that in passing. Then let me go to this. This is a slide that I pulled up off of EconPy, and it's a site I go to just about every month and look at. And basically what it is just a list of all the economic indicators. And over on the right-hand side, the right-hand column, the ones that are marked with an X are the ones that are considered by the Fed, I guess, or whoever sets this thing up as leading indicators. In other words, these are the ones that need to be watched carefully when we're floating up to a possible slowdown in the economy or a recession. And the one that really caught my eye this week was the unemployment claims, which I've noted here in red. So what I did is I went to the Fed site, and this is the Fed, I think, St. Louis site, and looked at the unemployment figures for, oh my, this goes all the way back to the 50s. And as you can see over on the right-hand side, that the unemployment rate in our economy is fairly low. It's quite low. In fact, it's at almost an all-time low. So a lot of the, if you look at the mainstream press, for crying out loud, they seem to be talking about the Great Resignation, when in fact, that's not the case when you look at the stats here. That is we're at a pretty low unemployment rate. And, that could probably be a factor in influencing inflation, but it certainly isn't what the mainstream press has been talking about. Now, I can understand that there's a lot of people who are out of work because they're sick because of the COVID situation, but that's a different statistic than this. So, I thought that was kind of interesting. And then this will kind of relate back to what I'm going to talk about when I get into the utilities. So one of the other things that you'll notice when you look at this chart, and I've kind of circled them in red here. I didn't do all the way back, but I don't know, there's 6 or 7 of them here. You'll notice that the unemployment rate, when it's at an all-time low or at a near low, is when is a good early warning indicator for a recession. Now, I'm not saying that, oh my God, there's going to be a recession this year or whatever. I'm just simply saying that this is one of the many indicators that could possibly be worth watching going forward, because it might, along with the other leading indicators, might be a good opportunity to understand when and if we slide into a recession. But this is pretty remarkable when you look at it in terms of its predictability. It's pretty impressive. So, having said all that, and I'll kind of tie it back to this. Just keep, by the way, keep your mics off so that we don't get a lot of noise in the presentation here. I won't mention anything else other than that. Oops, let me stop here a second. Let me back up. Let me stop sharing this particular screen and go to, I'm going to use fast graphs here because it's a fairly good tool for analyzing utility stocks. And I'm going to use this as kind of a basis for a discussion that we'll have a little later on. What I'll do is I'll turn off the recording when I finish my little part, my presentation here, and then everybody can chime in and talk about it. And I'm just picking all of the utility stocks. I have about 5 or 6 of them in here on the list. And the reason why I chose fast graphs is because it's a good fundamental analysis tool, and you can quickly go through and look at stocks and point out some of the general characteristics of utilities. And so let me quickly explain what this chart looks like. This happens to be Duke Energy. We could have picked any of the utility stocks. The dark green shaded area here is the earnings for the company, or excuse me, this is the, let me just go back to earnings. This shows you the earnings for the company, for Duke Energy, going all the way back for 20 years.
Shall we go to mommy? Go to mommy.
Can you turn off your mic, please? You can see, for example, that like most utility companies, they have a pretty steady growth in earnings. And then the light shaded area over on the right-hand side is the what the analyst community is estimating would be the earnings for this particular company moving forward. The white line is the dividends. And one of the things that really people underestimate in terms of utility stocks is if you look here, this shaded area here, that's the recession in 2008. There's the dot-com recession right there. And over here is the short so-called recession for the COVID occurrence. What's interesting about the white line is that all through these recessions, the dividends increased. So for an income investor, this is interesting because here's an opportunity to buy an old, stodgy, conservative, dull, if you will, stock that has an opportunity to give you income during a recession. Now, let's take this took a little bit, take this another step further, and I'll put on here the price of the, oops, that's not what I want. I want the price for the stock. So this just shows you the price of that stock during the period of time. Now, what's interesting about this is, let's just take the 2008 recession. If I click here, and then I click down here at the bottom of the recession, what this shows us is that the price of the stock, this happens to be Duke Energy, we could have picked some of the other utilities, it dropped 25% during that period of time. So if you were a savvy, wise investor, let's say, and you decided to buy this stock at the bottom, picking hard, that's difficult to do, of course, you could have earned, you would have had an increase in your dividend, and your yield on that stock would have been much higher. So your yield on cost would be very, very, very attractive. And so utility stocks at the right time make a lot of sense. Now, when is that? Well, probably the time before it starts to slide into a recession. And then maybe you can dollar cost average down in here to get a pretty good stream of income. And in fact, let's see if I go here. Yeah, you can see it right here. The red line, and let me get rid of the, let me get rid of that income. Notice the red line. The red line is the yield on the stock during that period of time. So in other words, if you bought the dollar cost average down in this particular area here, in the low part of that slowdown, your yield on that particular stock would have been something on the order of, I'm looking at 6%. So income investors are what I would call counter-cyclical. In other words, they buying the old saying is, when the recession occurs, that's dancing in the streets for an income investor, because it's an opportunity to buy at a very low price. And so that's what makes, I think, dividend stocks very attractive. Now, that's the good news. There's always bad news in this stuff as well. Let me go over here and do this. I'll go to the operating cash flow. And let me take the dividend off of there. This is the operating cash flow for Duke Energy. We could have picked one of the other stocks as well. And you can see, for example, the green shaded area shows you the cash for the operating cash flow for the company for the last 20 years. And you can see that the dividend is down here, the white line. And if you just pick any one of these points on here, you can see that the payout ratio is, fairly small, 33% compared to the overall cash flow for the company, or the operating cash flow. So this is a fairly safe operation. Now, that seems like, well, that sounds pretty good. I mean, geez, wow, we could do pretty well with that, right? Well, let's look at the other side. Let's look at the free cash flow. Not good. In other words, most dividend companies are capital intensive. And because they're capital intensive, they're constantly skating along the edge of what is positive cash flow. And in the case of Duke Energy, for example, here, you can see that there aren't many periods of time when their free cash flow is positive. And that's because they spend a lot of money in capital expenditures. A lot of these utility companies are, I guess, in the throes of trying to switch over to, energy-related approaches that are it's either, related to the nuclear or sun or some other source other than fossil fuels. And you can see that's through, I'll just click here to show you. Here's NEE, which is Nexteria. They have a very aggressive program in going to non-fossil fuels. In fact, if you go back to the what do you call it, the operating cash flow, you can see that their earnings do very, very well. They're free, but from a free cash flow point of view, they're not. That's not the case. So let me go back to Duke because that's probably a little better example. So what's the thing we have to be careful about here? I think what most of these companies, these utility companies, do is they operate on the basis that they have negative cash flow because they're using it for capital expenditures, and that's kind of living on the edge of a cliff, so to speak. If a black swan event occurs, and probably the most common one that everybody knows about is, when the Texas utilities had their big problems with the cold weather that they had down there, surprisingly cold weather, or PG&E in California had those terrible fires up in northeast of in Northeast California. Whenever a black swan event occurs, utility companies are not financially structured to be able to handle those very well. So that's where the real risk is, I think, in these utility companies. But if things are humming along and going along okay, you can do very well in them if you pick it at the right time. And so I would argue that, these utilities might make sense down here near the bottom of the recession. Now, well, how can you possibly pick the bottom of a recession? Well, you can't. I mean, there's just no way to do it. So dollar cost averaging into them might make sense when you're in a recession and sliding down. And your average cost could be pretty attractive. So that's kind of what I consider a real interesting possibility for these companies. Yes, they are boring. They are not very interesting, but they pay a dividend, and the dividend is there year in and year out. So when you're shopping for these guys, I think probably the best thing to do is to pick the ones that are A-rated or above. Now, if you go over here, and we don't have to use fast graphs for this, but down here you'll see BBB plus means that this company probably is not as credit rating, doesn't have a credit rating as good as, let's say, well, let's take Nextera here. Nextera is A-rated minus A- rated, but the disappointing news, the disappointment here is, as you can see, the earnings, for example, the price of the stock has outpaced the earnings by quite a bit. And so if you're going to take a position in it now, that would not be a good time, because, the stock is basically overvalued in that sense. This price to earnings ratio, by the way, is about a PE ratio of about 15. If you really wanted to know what the nominal price earnings ratio was for that company, there's the price earnings ratio for the company based upon the price. And as you can see over here, the blue, the earnings for Nextera is about 8.6, not the 15 that nominally would expect from a company like this. So Nextera, as an investment is overvalued. But if you picked, let's say, I don't know, let's go to Principal Financial Group. Yeah, maybe that's a little overvalued as well. How about AT&T? Wow, interesting. AT&T, while their growth opportunities are fairly small, granted, I mean, we all know that AT&T is spinning out a bunch of their divisions. I think they got themselves into a pickle with doing the DirecTV thing, and then also with the entertainment industry. But this stock is undervalued in my judgment. Okay, so the point here is there are opportunities here. Yeah, granted, AT&T will cut its dividend probably by 40 to 50%, but even then, it's still attractive. Let's look at, doesn't want to, slow to Verizon. Verizon is another typical example of an opportunity in disguise, but I think that might be slightly overvalued now. And this is another company I like to follow occasionally. But as you can see, these stocks are overvalued. But on the contrary, this one here looks like it has a very strong earnings growth for the next couple of years. By the way, if you go to Yahoo Finance website, all these forecasts are there as well. You don't have to subscribe to Fast Graphs to get these numbers. You can get them there as well. So let's see. I think that's pretty much. So when's the best time to get started watching these things? I would say probably when you approach a recession, when you start to get to a point where things on the horizon people are talking about possibly sliding into a recession. That's the time, I think, to make up a list of utility stocks and start to watch them carefully. And then maybe at the bottom of the recession, dollar cost average down in here somewhere to get a good yield on cost, basically. So that's about all I want to say. I probably have more notes on that I probably will occur to me after we start our discussion. But I will stop sharing here and ask for everybody to, or if you want, I can stop. I may welcome you guys to chime in and ask questions. And, maybe you have a utility stock that you're following that you want to see. The nice thing about Fast Graphs is it gives you a quick picture of what's happening with the stock from a fundamentals point of view. That's why I like it a lot. But you can get the same information from Yahoo Finance or, from Morningstar or Value Line. They all basically will give you the basic financial information. So I'm going to stop there. I'm going to also stop recording, and then we can open it up for discussion.
Hey, Andy.
Yeah.
I'd be interested in seeing
Time here about 3 o'clock or so, and so I wanted to thank everybody for their contributions to the discussion. It's always refreshing to hear different points of view on income investing, and especially with regards to how we would deal with these utility stocks. So I would like to say thank you to everybody for contributing and encourage you to continue your contributions at future meetings. This slide is the closing comments slide. It's a reminder that we do have a Google group that is available for everybody to use, and we'd love to have you use it and to share your ideas. It's there for your benefit and to exchange ideas. And there's my email address, and there is the email address for the Google groups so that you can contribute to your ideas. And of course, that's the site where you will see notices for future meetings. So without further ado, I would like to remind everybody that our next meeting will be on February the 6th, and I'll send out a notice to everybody when that occurs. So by all means, please keep your email open and avoid any spamming of notices so that the Google groups can notify you of our future meetings. So I will see everybody on February the 6th. Take care. Bye-bye.